part 3 of our introduction to the smart money concept. Hello traders, welcome back to my channel. In today's video we'll be completing the introduction to our smart money concept in this part 3. So in the part 1 and part 2 we actually introduced what smart money is. We talked about those who are involved in smart money. We talked about the various concepts, liquidity graph. We talked about liquidity zones. We talked about consolidation. We talk about accumulation and distribution in part 2, and then we showed you how this actually happens. So in this part 3 we are going to be taking this concept and explaining them detaily, so that you can best understand and you'll be able to take your decisions. So in this part 3 we are going to be explaining this concept detaily, and then we talked about how these banks operate, how they actually mitigate, what is actually mitigation, and then we'll show you how they actually operate by hedging, taking trades in order to grab liquidity and all of that. At the end we are going to see live examples of liquidity grab scenarios, as well as mitigation scenarios in our charts. I'm going to use VRX75, John Indices, forex pairs to show you how. So the next thing that we'll be looking at is mitigation. Okay, so remember we explained in the first part of this series that whenever price rejects in a zone like this once, twice and thrice, there's mostly a tendency that the market makers will try to push price below in the process of accumulating, so as to grab liquidity and continue up. While if price creates a resistance zone, market makers will try to move price up and grab liquidity before continuing moving down. Okay, in these scenarios what actually happens here is this. Okay, so let's take this example. Let's talk about a resistance zone now. So assuming we have a resistance zone here, alright, so and then we have maybe a support. Let's just say that have a support here. And you know that mitigation is a way by banks in order to get out of their negative orders without actually taking losses, or let's say getting out of their negative orders, or they are losing trades at break even. So now you see that when price move in this situation, let's say this is a resistance zone, price gets rejected at that resistance zone. Okay, once, twice, okay, let's say thrice, can still respect 3 times, it doesn't matter. So maybe the 4th time now, when people are already selling. Okay, so when people are now selling, what happened? Now they will execute buy orders because they have heavy lots here. They already know that people will be selling. Many retail traders will be selling here, while others were placing sell limit orders here. They are going to buy. So when they buy here now, they move price up to this liquidity zone up here. Alright, this is the liquidity zone up. Around here we have many stops around here. So when they move price up now, what happened? Price get to this zone. So when price get to this zone here, now because they have executed buy trade here in order to move price up, okay, so when price start moving up now, what they have to do now is to counter this trend. They have to open sell trades up here after grabbing liquidity above here. So these sell trades now are in order to able to move price down. So in order to move price down, they will have to execute heavy sell orders that are heavier than these buy orders, because these buy orders here, they are the ones that were moving price up, but now they need heavier orders to be able to counter these orders. So they place heavier orders with bigger lots compared to this. So as a result, price will now start moving back down. When price start moving back down, you see that these sell orders are pushing price down, while the buy orders are still open. They are still open, right? So this will move price down. We have heavy sell orders. Price will be moving down because of heavy sell orders. Now what happened? The sell orders are in profit, while these buy orders are in negative or are in losses. Okay, so now what happened? They will start closing. As price start coming down, they will be closing some of these winning trades. They will be closing them one after the other. When price reach a particular level now, when they have closed them, and we only have those heavy buy trades that are here, that are currently running, and these buy trades, remember, are negative because they are already in a loss. All right, price is already moving now. So when they have closed, must have closed most of these sell orders, what happened? Price now will have to move back up. They are closing it so that price can start moving up. There's no force, no heavy force that is pushing price to move down. So now we instead have a pulling force that is pulling this price to go back up, because we have very heavy buy trades that we're taking here in order to grab liquidity. So now price is now moving up. Okay, so they will move price now up. When price move and reaches this zone where they initially executed the sell orders, what happened? They are going to close them now. Remember here, they are now be closing them at zero, because this is where they bought. They'll be closing them now at break even, so they will not incur loss. That's what we call mitigation, and that's why when they have closed all of the trades, most often you see that price will move back like this. All right, so it will be something like price move and then it get rejected, and then when it breaks out, it comes, and then when it comes down, it goes again, reaches around the zone where the mitigation took place. See price move down. That's why you are going to see this in the chart examples that I'm about to show you now. You are going to see many examples, and you see candlestick, you see charts behave like this. This is the reason behind this. So this is what we call mitigation. This is how banks and institutions mitigate. So we are going to move on to the live chart examples. Where we have a support zone. Okay, so you see that when price gets rejected once, it gets rejected a couple of times, all right, at least more than one. Once it breaks through the zone and then it grabs liquidity, okay, and then you see that it moves back up. The same concept applies here, now in an opposite angle of view. So you can see here that what happened is, actually, when price comes the third time, the market makers here, they will execute sell orders in order to push price down, while many people actually buy. So because there's liquidity lying below this zone, market makers would like to move price down in order to grab liquidity and then now start countering the move. Okay, so when price comes now, they sell, and then price moves down, grab liquidity here. What happened? Down here they are going to buy. They are going to buy with huge lots. These huge lots will be bigger than these ones here. So this buy lots will be bigger than these sell lots, in order to counter price, because if they don't buy, price will just continue going down and down and down, because they are trading with very huge lots. Okay, so when they buy now, they counter the trade, it start moving. After they have grabbed liquidity here, price now start moving, it moves up. So when it moves now, what happened? They have their negative orders. Now they have but sell orders here that are still running, but their buy orders are in profit. Okay, so they have actually hedged, what we call hedging. They have sold and bought at the same time, but they know how they are going to get out of it with profit. So when price start moving up now, they start closing some of the buy trades with profits. Remember, okay, they are closing it now so that price can move back here, and when price move back here where they initially placed the sell orders, they are going to mitigate the orders, and then they'll close the trades at break even. This is what we call mitigation. So when they start closing, price will now start moving up, because remember, if they don't close these heavy buy orders here, price will just be moving and going and going. But now they will have to close them such that we have only sell orders. These sell orders now will now start pulling price back. When price moves back to the initial zone where they placed those sell orders, remember this was the initial zone, they are going to close all the sell orders at break even, and this is what we call mitigation. From there, you see that in some cases you see price continue and it moves. So that's basically it. Now let's move on to chart examples that I'm going to share with you. Remember, I said this thing will work in all markets. Okay, it works in all markets. If you want me to show you different symbols, you are going to see aspect of liquidity grab in. So we have this is volatility 75 in front of us right now, and in volatility 75, that is a synthetic indices. Okay, I'm just sharing you as an example. I'm going to go to currency pairs, and you're going to see we have this scenario here. This was a scenario where we had liquidity, it got rejected, it got rejected, it got rejected. When it came, liquidity grab and all of that. So they took their sell orders and grabbed liquidity, took buy orders, price moved up. So what happened? They will have to look for ways to come and mitigate this zone. Alright, so this is basically it. Now what happened? Price was moving up, and it actually looked for a way to come back. This is where price came back and mitigated the zone. This zone was exactly at the point where those sell orders were taken so that price can move down. So you can see how beautiful the concept is. The concept is such a beautiful concept because it can apply everywhere. So if you go, I can further show you in other indices. I can equally show you this in Jump 100, and so this is Jump 100. So this is Jump 100. Let's just delete this for the meantime. The main purpose is for you to get the concept. Okay, this is Jump 100. So we had a zone here. Let's go to the 1 hour time frame. Okay, so price got rejected here once, twice, and created demand side. And what happened? It came down, it broke down, created demand side liquidity. When it created demand side liquidity, it moved up. When it moved up, what happened? They start closing their buy orders, and price came back. When price moved back, it came back and mitigated the zone. This is the zone, and this is exactly at the point where we had the negative orders. Alright, this is where we had the negative orders that were running. So when price came back now, here it mitigated the zone, and now price finally shoot up. So we can see go to our forex pairs, and I'll see show you examples of that. Okay, remember the concept, the idea is for you to get to understand the concept. Alright, when you understand the concept, it's going to be easy for you to build a strategy based on this. Alright, I'm not going to be telling you that do this, buy, sell or not, but if you understand the concept very well, you are going to take trades based on that, and that's going to help you. So you see situations like this, price get rejected once, twice, it came, it break down, and then what happened? It had to go up, come back and mitigate, and then it continued, it shoot up. So I'm just trying to make you understand how powerful this works, and it works in any market. It equally works in any time frame. So the market is fractal. If you see these patterns in the 1 hour time frame, you can see it in the 15 minutes, in the 5 minutes, and all of that. So here we have similar scenarios. Here. Price got rejected once, it got rejected twice, and then here we had liquidity grab below the zone. Price moved up. So we had negative orders that were running here. Price had to go up, come back, and then mitigate the negative orders that were running here. And then what happened? Price had to shoot up. Alright, so you see the concept, it applies. It's just as clear as that. Up here we have the supply side liquidity. It got rejected many times, and when it finally broke out from this zone here, what happened? It closed back inside the zone, and I've already explained the reasons for all of this. It came down, what happened? And then it created another zone here, went up and mitigated the zone. This is exactly the point where those negative orders were placed, and the price came back, mitigated the zone here, and finally moved down, creating another zone. So this is another area here in which I can show you, but let me move to a smaller time frame so that you can be able to see it clearer. Alright, I don't want to assume that most of us here are pro traders, that we can identify some things in bigger time frames. I just want to assume that we are beginners. Okay, so most of you might not understand what I see in a bigger time frame, so I'll have to make it very clear for you. Remember, I said I want to make the concept just very simple, such that just at a glance you will be able to understand. So it should just be as simple as possible. So you see price rejected. What happened? It came down here, it grabbed liquidity below the zone. So liquidity got grabbed, and then it went up, now came back, mitigated. Alright, this is the point where the negative orders were. Okay, it came back, it mitigated the zone, and price had to move up. So that's basically the concept. So that is the end of part 3, and we have talked about many things, starting from liquidity. We have explained consolidation, distribution, accumulation. We have explained mitigation, and I've explained to you detaily how banks, and institutions do manipulate price to get liquidity and all of that. Like I said, this is not to tell you when to buy or when to sell. This is for you to understand the concept, because as soon as you understand the concept, you are going to take decisions based on that. Now, in the subsequent videos, I'm going to be bringing to you guys case studies on my own personal way in which I take my trades based on this concept. So I'll be bringing to you guys live analysis and trades. So make sure you continue following the channel so that you can get my own opinion about this. Okay, so if you have not watched the other parts, make sure that you go back and then watch the part 1 and part 2 of it so that you can understand everything clearer. And if you are new to this channel, just click on the subscribe button, click on the like, click on the notification bell so that whenever I post a new video, you are going to get notified. Alright, thank you for watching. See you in the next video.